Are you unknowingly sabotaging your own investments? In today's video, we'll reveal how the Dunning-Kruger effect might be causing you to make costly mistakes without even realizing it. Stay tuned to uncover the 5 ways this psychological phenomenon is hurting your investments and learn how to overcome it for better financial decision-making. You don't want to miss these eye-opening insights, so let's dive in. The Dunning-Kruger effect is a psychological phenomenon that explains how people with limited knowledge or experience in a particular field tend to overestimate their abilities, while those with more expertise may underestimate their competence. Named after social psychologists David Dunning and Justin Kruger, this cognitive bias is prevalent in various aspects of life, including personal relationships, education, and career decisions. In the context of investing, the Dunning-Kruger effect can lead to overconfidence in one's ability to make sound financial decisions. As a result, individuals may take on excessive risk, trade more frequently, or fail to diversify their portfolios, often leading to subpar investment performance. Acknowledging the presence of this cognitive bias and taking steps to counteract its influence can help investors make more informed decisions and achieve better long-term results. Understanding the Dunning-Kruger effect can help individuals recognize their limitations and seek out opportunities for continuous learning and self-improvement. This awareness not only benefits investment decisions but also contributes to personal growth and success in various aspects of life. Without any further ado, let's count down the 5 ways that the Dunning-Kruger effect is hurting your investments. Number 5. Overconfidence in stock picking. Overconfidence in stock picking is a widespread issue among individual investors, which can lead to suboptimal investment decisions and, ultimately, underperformance. When investors become overconfident, they tend to believe they possess superior knowledge or skills, allowing them to outperform the market consistently. In reality, this overconfidence often results in errors, excessive trading, and a lack of diversification in their portfolio. One of the primary reasons behind overconfidence is the Dunning-Kruger effect, a cognitive bias that leads people with limited knowledge or expertise to overestimate their abilities. This can manifest as an exaggerated belief in one's ability to predict stock price movements, identify undervalued companies. Further, investors may be under the illusion that they can somehow manage and control the outcome of their investments, despite the numerous external factors that influence stock prices. Overconfidence can have several negative consequences for investors. Firstly, it may lead to excessive trading. Overconfident investors may frequently buy and sell stocks, thinking that they can time the market effectively. However, studies have shown that most investors struggle to outperform the market consistently, and excessive trading often results in higher transaction costs, eroding returns over time. Secondly, overconfidence may result in a lack of diversification. When investors believe they can accurately identify the best stocks to invest in, they may concentrate their investments in a small number of companies. This lack of diversification can expose the investor to higher levels of risk, as their portfolio becomes more susceptible to fluctuations in individual stocks. Thirdly, overconfidence can impair decision-making. Overconfident investors may dismiss or overlook valuable information that contradicts their beliefs, leading them to make poor investment choices. Number 4. Neglecting diversification. Limited knowledge of diversification is a key factor that can lead investors to underestimate its importance, resulting in inadequate risk management in their portfolios. Diversification helps reduce company-specific risk by spreading investments across a range of asset classes, industries, and geographic regions. This can help protect the investor's portfolio against sharp declines in individual assets or specific market sectors, leading to a more stable overall performance. Some investors may believe diversification to be simply owning a large number of stocks or other assets. However, true diversification involves investing in a variety of assets with low correlations to each other, ensuring that the portfolio is not overly exposed to any single risk factor. Limited knowledge in this area can result in an investor having a false sense of security, believing their portfolio to be well diversified when, in reality, it is not. Investors may not appreciate the need to invest in different asset classes, such as stocks, bonds, real estate, and commodities, to achieve a truly diversified portfolio. For example, they might focus only on stocks and neglect other investment options. Lastly, investors may rely too heavily on past performance when making investment decisions, assuming that historical trends will continue indefinitely. However, past performance is not a reliable indicator of future results, and over-reliance on it can lead to a poorly diversified portfolio that may not be well equipped to handle changing market conditions. Number 3. Misjudging risk and reward. The Dunning-Kruger effect can lead investors to misjudge the potential risks and rewards of their investments, resulting in a higher likelihood of financial losses. Investors suffering from the Dunning-Kruger effect may be overconfident in their ability to identify high-performing investments. This overconfidence can lead them to overestimate the potential returns on their investments, causing them to focus on assets that promise high rewards without considering the associated risks. As a result, they may invest in highly speculative or volatile assets. Similarly, they might not fully appreciate the various factors that can negatively impact their investments, such as economic downturns, changes in interest rates, or geopolitical events. This lack of risk awareness can lead them to invest in assets with higher than anticipated risk levels, increasing the chances of financial losses. Investors influenced by the Dunning-Kruger effect may not grasp the fact that higher potential returns are often accompanied by higher risks. They might be attracted to high-performing assets without considering higher risks. As a result, their portfolios may be overly concentrated in high-risk assets, leading to increased volatility and potential losses. Investors under the influence of the Dunning-Kruger effect may not appreciate the importance of implementing risk mitigation strategies, such as diversification, asset allocation, and regular portfolio rebalancing. Their overconfidence in their abilities may lead them to believe that they can accurately predict market movements, and thus do not need to employ such strategies. This can leave their portfolios exposed to higher levels of risk and potential losses. If you're enjoying this video and finding our tips valuable, don't forget to hit that like button and subscribe to our channel. Not only will you stay updated on our latest investing advice, but we also have some practical tips to avoid the Dunning-Kruger effect. So, stick around to discover even more insights to supercharge your investing journey. Now, let's dive back into our guide and explore the final 2 ways the Dunning-Kruger effect is hurting your investments. Number 2. Ignoring expert advice. The Dunning-Kruger effect can lead investors to dismiss valuable expert advice, causing them to miss out on potential insights and opportunities for growth. Investors influenced by the Dunning-Kruger effect may be overconfident in their own abilities and knowledge, leading them to believe that they do not require expert advice or the need to consider alternative viewpoints. Investors suffering from the Dunning-Kruger effect may be resistant to considering or incorporating expert opinions into their decision-making processes, but rather dismiss them as unnecessary or irrelevant, leading to suboptimal investment choices and missed opportunities for growth. These investors may also exhibit confirmation bias, which is the tendency to search for, interpret, and remember information in a way that confirms their pre-existing beliefs. As a result, they might be more likely to seek out and accept information that supports their views while dismissing or ignoring expert advice that contradicts their beliefs. His selective approach to information gathering can hinder their ability to make well-informed investment decisions. The Dunning-Kruger effect can create a sense of self-assuredness that may cause investors to be less open to learning and growth. They might not see the value in expanding their knowledge and place too much emphasis on their self-directed investment strategies. Number 1. Failing to learn from mistakes. The Dunning-Kruger effect can cause investors to overlook their own mistakes, hindering their ability to learn and improve their investment strategies. They may be unable to accurately assess their own performance due to their overconfidence and limited self-awareness. As a result, they might not recognize when they have made mistakes or poor investment decisions and prevent them from addressing the root causes and taking corrective action. When confronted with negative outcomes, investors suffering from the Dunning-Kruger effect may be more likely to attribute their losses to external factors, such as market conditions or unforeseen events, rather than acknowledging their own mistakes. Investors under the influence of the Dunning-Kruger effect may be resistant to receiving feedback, particularly when it contradicts their beliefs or highlights their mistakes. This resistance can limit their opportunities to learn from others and grow as investors, leading to repeated errors and suboptimal investment decisions. They may focus too heavily on their successful investment decisions while downplaying or ignoring their mistakes. This selective attention can create a distorted perception of their overall investment performance, leading them to believe they are more successful than they truly are. As a result, they may not see the need to learn from their mistakes or modify their investment strategies. The overconfidence and self-assuredness that characterize the Dunning-Kruger effect can lead investors to become complacent in their investment strategies. They might believe that their existing knowledge and approach are sufficient for success, leading to stagnation and a lack of growth. This complacency can prevent them from seeking new opportunities, embracing innovation, or adapting to changing market conditions, which can ultimately hinder their long-term investment performance. Some practical tips that beginner investors can implement to mitigate the impact of the Dunning-Kruger effect include: seek advice from experienced investors and professionals. Diversify your portfolio. Continuously educate yourself about the market. Practice humility and self-awareness. And lastly, set realistic expectations and goals. That wraps up our discussion on the Dunning-Kruger effect and the ways it can hurt your investments. We hope you found these tips helpful in recognizing and mitigating the impact of this cognitive bias on your investment journey. If you enjoyed this video and found it valuable, please hit the like button and consider subscribing to our channel for more insightful content on investing and personal finance. We'd also love to hear about your experiences with the Dunning-Kruger Effect in investing, so please share your stories and thoughts in the comments section below. Remember, the key to overcoming the Dunning-Kruger Effect is to continuously learn and grow as an investor. Stay curious, stay humble, and always be open to new ideas and perspectives. Together, we can become smarter and more successful investors. Thank you for watching, and we'll see you in the next video.